Sponsored by New Orleans Distillers, creators of fine spirits and liqueurs. Through dedication to science, art, and passion, blends of tradition and flavor emerge. For you, always locally crafted. New Orleans Distillers, classically Southern.
Tonight, April's Consumer Price Index was released this week, and inflation was higher than expected at 8.3%. Elon Musk puts on hold his takeover of Twitter, and the Biden administration is canceling any new oil and gas leases in the Gulf of Mexico and in Alaska. We'll have that and more tonight on this Friday the 13th, 2022. Hi, I'm Andre Laborde. Welcome to Wall Street Wrap-Up on this Friday, May 13th, 2022. Hope your week went well. Well, coming up tonight, we're going to be talking tech and internet stocks. Is now a good time to get in? We're going to be talking with Evercore ISI's Mark Mahaney. Mark is the Senior Managing Director at Evercore ISI, and for the last 15 years, Institutional Investor has named Mark as one of their top 3 analysts for tech and internet stocks. Mark has also just written a great book called Nothing But Net. Mark's also a regular on CNBC's Fast Money program, and he's going to be with us coming up just a little bit later on in the show. But first, how did the markets do this week? Well, all the indexes were in the green for the day, but ended up in the red for the losses that they had experienced during the week. This week, the Dow Jones ended at 32,195, which was down 2.1% for the week. And the S&P 500, they closed at 4,023, which was down 2.4% for the week. And the NASDAQ, they ended at 11,805, which was down 2.8% for the week. Well, let's get to our guest this evening. Mark Mahaney is Evercore ISI's head of the Internet Research Team. He's also the Senior Managing Director, and he's the author of a new book called Nothing But Net. And best of all, he's here with us right now. Hi, Mark. Welcome to Wall Street Wrap-Up.
Good to be here, Andre.
Thanks, Mark. You know, when we were locked down for such a long time, I refer to them as the lockdown stocks. And I'm thinking of Netflix, Peloton, DocuSign, name Zoom. Do you think they're going to be the high flyers like they were back in 2020 and early 2021?
No.
Okay.
No, because for a variety of reasons. One, we just have a fundamentally different tape now than we had back then. I'm sorry, it is a night and day difference. I'm just going to start with the gloom, and then I'll give you the upside. We are in a severely, aggressively tightening rate environment. We haven't been in this kind of environment in years. And maybe decades. And we're coming out with so many inflationary factors. Look, we've got record. It's coming because we're in a record high inflation rising environment, and that's due to a confluence of factors. But most recently are lockdowns in China, and of course the Russian invasion of the Ukraine. But there are other factors at play here too that caused this inflation to be where it is. So as inflation stays high, interest rates are going to be rising aggressively higher. That's always negative for long-duration growth equities assets where they trade with high multiples and future profits. So that's a very negative environment for those COVID winners. That said, some of them did really gain a lot of traction and gained. It was a major marketing event for almost all things digital. I think in a way it kind of forwarded adoption of these things like streaming services and online grocery delivery and digital physical workouts, the Peloton type workouts. But we are in a deep correction mode, in part for reasons that have nothing to do with COVID, at least not directly, and that's rising rates, and which is driven by inflation.
Have we hit the bottom, or how long? Is there a way that we can tell that this is going to be the bottom, that then they'll start to rise?
Well, Andre, I think you probably lived through just as many bear markets as I have. As a tech analyst, tech investor, this is my 7th bear market. And, they don't normally fizzle out after just a few months. We had such an unusual bear market in February, March, April of 2020. It was such a dramatic correction and a dramatic spike back up. I think that really was the unusual bear market. Usually the duration is 6 months or longer, 12 months. And the kind of the magnitude that we're seeing isn't terribly shocking. You go 20% to 30% and 30% for the more speculative names, which would be tech stocks and growth equities. So I think it really comes down to we've had inflation shocks leading to interest rate shocks. What we don't know is whether we're going into a recession or not. I think a lot of the valuation risk has been taken out of the sector that I look at, tech stocks. And that's going to depend on whether we go into a global recession. I've got a great example for you. Amazon, when they reported numbers, they reported a lot of problems on the cost side because of spiking fuel costs, spiking trucking costs, spiking container shipping costs. But when they were asked about what they were seeing in terms of consumer demand, they said they hadn't seen any negative inflection, no worrying signs yet. Well, that means that street numbers were set and investors' expectations are set based on cost concerns, but not revenue concerns. If we go into recession, there will be revenue concerns. So if we're sure that we're not going into recession, I think we're very close to a bottom on the market. If we are going to go into recession, I think the market will continue to drag down.
Now, interesting you say that, Mark, because I remember, and like you were talking, I remember very well the 2007, 2008, the financial crisis. Yeah. And one of the things that happened was that for about 3 months or so, the market dropped. I'm talking about the S&P. The S&P dropped for about 40 to 50%. And then it rose for about 3 weeks. It was up around 20% for about 2 to 3 weeks. And it gave people like a false sense of, hey, the bottom's hit. We've already hit the bottom. And that came up for a couple of weeks, and then it dropped again for about 3 weeks. Well, it scared away so many of the baby boomers and others that were more novices to stocks that I bet you plenty of them haven't even gotten in. And they've missed 12, 14 years of great returns. I'm curious, do you think that there may be like a false bull test, my terminology, a false bull test this time where it may look like it's at the bottom and it starts to go up and then it'll start going back into the bottom again?
Andre, my honest answer is I don't know. Your recall of history is pretty good, Andre. It's better than mine. I don't quite recall that, but I'm sure you're right about what happened to the market during the great financial crisis. I think that's probably the environment that we have to think about, that kind of duration, and that had that full economic impact, and we haven't seen the full economic impact. So, and I'm going to give you plenty of reasons as we go on to be optimistic, but for now, I think if multiple risk has been taken out, and I also want to put it in context, we had from a tech sector perspective, that's really what I look at. We had 2 phenomenal years for tech stocks. 2020 and 2021, NASDAQ dramatically outperformed. There are these cycles. There is something called reversion to the mean. It shouldn't be terribly surprising to any of us that tech stocks have underperformed this year. And if you had known going in what was going to happen to interest rates, if you had known going in that there was going to be a war in Russia, if you had known going in that we were going to have COVID lockdowns again in China, you probably would have steered clear of tech stocks. It's hard to know what's going to happen, of course. And so to predict what the way we come out of this, I would think that you're going to have a lot of false moves, up and down. And I've never seen a market move smoothly up or smoothly down. So I would expect that what you described is what happened in the great financial crisis. My guess is that we'll have a repeat of that.
I mean, I'm curious about tech stocks, is that usually when interest rates start to rise, tech stocks normally get hit first. Well, now that tech stocks are normally the ones to start rising first, once things, as you just said, once we do hit a bottom?
Tech stocks can rise as interest rates are rising, but I think investors need to have kind of a clear path of the rate of the increase. Over the last 6 months, Andre, as you and I have been watching this, we went from 1 rate increase in 2022 to 3 to 4 to 5 to 6 to 7, 25 bips, 50 bips, 75 bips. I mean, there's just a level of uncertainty, and it was accelerating uncertainty or it was uncertainty over the acceleration of interest rate increases. And so tech stocks are not going to work in that environment again. And there's a simplistic reason for this, is that a lot of growth equities, the value, they don't generate a lot of earnings today. It's all in the future. So you're talking about these what they call these terminal values. And if it's future money in the future, earnings in the future, well, you got to discount that back. And if you're raising interest rates, that means you're raising discount rates, which means that future earnings gets crushed. That isn't the case for a company that's generating $5 in the ground this year. You can only crush that so much. I mean, economics could negatively impact, but rates don't. Anyways, that's why the tech sector is much more at risk in a rising rate environment. The other thing, though, I'm going to get back to it is there another shoe to drop? Are we going into a recession? I mean, it's not. There's some material chance that we're going into recession. I don't know if it's 10, 20, 30%. There's some chance out there. There are parts of the world, unfortunately, like Europe, because of the Russia-Ukraine exposure, where there's a probability, greater than 50% chance of a recession. And the more you get international recessions, that increases our chances here. So that's the other shoe. I hope it doesn't drop. And if it doesn't drop, you can start wading into tech stocks, I think, this summer. If that other shoe drops, I think it may take till the beginning of 23.
If this is what's the market's happening with the first interest rate rise at 0.5%, 50 basis points, do you think that every time that they start raising it 50%, it'll be that way, or do you think that this will be the first initial shock, and then the market will be now used to it?
If there's consistent 25, 50, whatever the number is, interest rate increases. It's just, Andre, we've lived through so much. The number of interest rate hikes this year, the expectation of it has risen dramatically in the last 6 months, and the magnitude of the increases has risen. With the interest rates, if you're going to have a couple of these 50s, but then you start moderating and it's more like, well, there's only one more left to go, or we're going to go down to 25 bips, something where it gets less worse, then that can be very much of a tailwind for growth equities, especially given all the devaluation that we've seen in the sector. We've definitely knocked down valuation or multiple risk across tech stocks.
So stocks have gotten cheaper, and in certain cases, the question is, are they now cheap?
So the honest answer is, I think they are. I don't know. I think they are. And again, the big caveat is if we don't go into a recession, these stocks are cheap. I think that if-then statement is correct. If we go into a recession, the stocks probably aren't cheap, but they're not expensive. Earnings estimates depends on the rate of the depth of the recession. The earnings estimates will have to come down. So what looks like to me 18 times earnings for Google, which I think is highly attractive, maybe 20 times Google's earnings if those earnings need to be cut down. So when we have confidence that the earnings estimates don't need to be cut, then the stocks are cheap. And I just want to step back a little bit. I've lived through a lot of these cycles before. You make more money buying tech stocks, growth stocks in a bear market than you do in a bull market, or at least as an entry point. Now, whether you can call the bottom or not, I'm skeptical that anybody really can. I know what the conditions are, I think, that lead to a bottom, but there's too many forces, and when they all converge, rates, inflation, and economies and geopolitical issues like the Russia-Ukraine war, when those all converge to be sort of neutral, is a very hard thing to know. But what I try to do is at least identify what I think are the highest quality assets. In the space I look at, and especially in consumer tech, I mean, it's Apple, Amazon, Google. I even think really controversial name like Meta or Facebook. And I think these things at some point are going to recover to, really nice growth like they had prior to this year. I think their multiples will re-rate. These are highly profitable business that generate tons of cash. They return some of it to shareholders. They're aggressively investing in new business initiatives, whether that's the metaverse for Facebook, whether it's autonomous vehicles for Google. Apple has augmented reality, virtual reality, and other things, services. So these companies that are really been stalwarts of tech in the past, I think they're going to be stalwarts of tech in the future. Here's a chance to add them to your portfolio at a 20-30% discount. That's usually a pretty good bet. But you have to be a long-term, investor in order to do that. You have to be willing to look out 12 months. Next 3 months, I think those stocks are just as likely to go up 10% as down 10%. The longer duration you have as an investor, the much better the risk reward looks on those names.
I'll tell people, I'll change up the terminology and say, when in doubt, don't do something, just sit there. And when it comes to these kind of stocks, that you do have to have a far-term horizon. And there's the acronym of FANG. FAA. Now, I'll put two A's in it, sometimes without one A, but which is the Facebook, Apple, Amazon, Netflix, and Google. So you think things, stocks like Meta, which was the old Facebook, Apple, Amazon, and we talked about Google a little bit. What about Netflix? Do you think Netflix is going to be coming back into its own?
No, I don't actually. So, I published a book last year and I talked about this wonderful acronym, the FANG acronym, and how well it did. And I also talked about when you know when to sell a stock. And, for me, there's some tells in here when growth rates decelerate sharply below 20% for high quality, growth assets. You don't want to stick around. And I think that moment happened with Netflix over the last 6 months. I downgraded it at the beginning of the year in January. I think what Netflix has done is they've done a phenomenal job. It's been a great service. It's a great management team. It's been a phenomenal stock. It was the single best performing S&P 500 stock in the last decade. But that's the last decade. Now what they've shown is the challenge they have in trying to maintain the premium growth they've had before, because they've done such a good job in the U.S. and COVID kind of accelerated them to maturity. They're at 60% of North American households, 60% of many West European households, 60% of Latin American households. So the growth now has to come out of Asia Pacific. It's a much harder challenge, much tougher market, much more competitive market for Netflix. They haven't been able to grow as well in those markets as they have in the rest of the world. They've talked about advertising. They've talked about cracking down on password sharing. They've talked about rolling out mobile games. Those are great growth initiatives, but they're on the come. And so that's probably 2 or 3 years from being material to the business. So you've got an air pocket. An air pocket on a growth stock is not a place where investors want to be. I don't recommend Netflix as a stock. It was a wonderful stock in the past. I think for now, enjoy it as a service, enjoy it as a consumer. Maybe I may well come back to it in a year, 2 or 3 years, but it's a no man's land for the next year.
If you're just joining us, we're very happy to have Mark Mahaney. Mark, senior analyst over at Evercore ISI, but also want to mention he is the author of the book, Nothing But Net. And we're going to be talking more about that, not only in this show, but in other shows as well, too. We're going to take a break, but don't go away. We'll be right back. We're talking with Mark Mahaney from Evercore ISI. He's also the author of the book, Nothing But Net. Mark, right before we left into the break, we were talking about Netflix, and I'm curious, Netflix was at one time a stock that was over $600. Now it's trading in about, give or take, about the $200 range. All right, and I'm wondering, would companies such as Apple, that has a large cash hoard, or Disney, or other types of entertainment type stock, because Apple has their Apple TV, would something like Netflix be a good takeover?
I get it, Andre. You're wondering whether there's an M&A play for Netflix, whether an Apple or Disney would buy them.
You read my thoughts.
Google.
Right.
Yeah, Andre, I think it'd be a hard deal to have to transpire. Probably at the top of the list is regulatory concerns. I don't think that that I can see some natural strategic acquirers: Amazon, Google with YouTube, Apple. Maybe Disney. Maybe Disney would be able to pull it off. But the first 3 companies I just mentioned are the 3 companies that are most under scrutiny by regulators because of their size. I just think it's unlikely. And then the problem with traditional media companies is now actually Netflix is cheap enough. I mean, we're talking about an asset not on free cash flow, but on earnings, not adjusted earnings either, like real GAAP earnings. Is reasonably priced. It's 15 to 20 times earnings. So I could see another media company now coming in, and there's no super voting, stock structure. There's no
Right.
family
Okay.
ownership at Netflix, so that's possible. I don't think a big tech company could do it for regulatory reasons. Could another media company do that? And would they want to? Well, there clearly is a move towards streaming, and the global leader in streaming right now very clearly is Netflix. So I think the idea that you have is actually very interesting. I would have just changed the suit, the potential acquirers.
When the analysts at Evercore ISI put out a price target for, like, let's say Amazon, and they do it in May, are they looking at because of right now the market being up and down, are they looking like a 12-month period? Are they looking at 24
No,
months?
yes. No, you're right. No, Andre, look, I always look at 12 months out. And I tend to think, by the way, that's the best way to invest in these assets. I really counsel people, don't trade around earnings. Invest in stocks. Try to identify the highest quality assets out there. Find names that you're really intimately familiar with. One of my youngest son was asking me for a stock idea for his school, and I said, well, which of these companies do you use the most? And he said DoorDash, which of course then caused me to go back to my credit card statement to realize what was on there. My advice to him was, you know the service, you use it, you'll be able to tell the nuances when they do something different or new or better or worse. I look 12 months out on these names, and I really do try to identify the highest quality assets. And then I also try to find stocks that I think are very particularly appropriate to this particular time. I'll give you one quick example of that. Booking, BKNG is the stock. It's a travel play. It's formerly known as Priceline.com. We are going through there's very strong pent-up demand for leisure travel this summer. I think Booking is a great way to play that. I refer to it as a Venn diagram stock. So it's a reopening play because we're reopening, we're traveling again, and it's what I call a high-quality asset. Battle-tested business model. They've been around for 25 years. I love that there are very few of those names, but that's one of them. So I try to also identify assets that are very specific to the time period. Booking is one of those.
Just last week, I think Bookings came out with their earnings, and Marriott came out with theirs. Airbnb. Someone was asking me about Airbnb just a week ago of what I thought of their type of a stock. Do you think travel-related industry is also something that's going to be strong for a good period?
Yeah, I think fundamentally it's going to be strong. Then you have to check out the valuations. I like Airbnb. I prefer Booking because you want to be as defensive as possible in this market. You want to be able to say, this is trading close to a market multiple. Airbnb is a wonderful company. They're gaining share in the space. I would not call it a cheap stock. It's a growth stock, and it trades like a growth stock with a growth multiple. So you're in this environment, you want to take on as little multiple risk as you can. This is going to be one of the strongest travel seasons per the airlines, per the hoteliers, and per the online travel agencies. One of the strongest summer travel seasons we've had in years.
True. Let's say someone comes to you and says, Mark, I'm scared. And they don't remember the other times of, 2008, or they don't remember how much of a panic it was. They don't remember September of 2001 and such. What would you advise the average person who opens up their portfolio once a month from their investor and sees the sea of red?
Pull up a web browser, go to the internet, look at go to Google Finance, Yahoo Finance, a site like that, and just pull up a basic chart. You can do the S&P 500 or NASDAQ. Don't do it for 3 months. Don't do it for 6 months. Go look at it over a 10-year period, 20-year period. And what you do see is this very clearly rising pattern over time because stock prices do follow fundamentals, and the economy and these companies get bigger and bigger over time. So not all companies, of course not. The economy does though, and so that's why the market over time has been rising. And you look at that chart, you want to pick the lower points to add to your entry, to add to your positions, or to start new positions. So that's what I would tell somebody, which is this too shall pass, 2 Corinthians. And, we have gone through this time again. And, I'll probably also quote something like Thomas Paine saying, the harder the conflict, the more glorious the triumph. He said it about the American Revolution. I'm saying it about financial markets. The greater the risk, the more the return. We're in risk land right now. And, if you're starting as an investor, you're going to go through this probably 5 or 6 or 7 times in your life. But don't run from them. learn to live with them, learn to take advantage of them. And you want somewhere in here, you want to be buying stocks. You don't want to be selling stocks. And for long-term investors, I think they'll look back on this as what would have been a great buying opportunity. I don't know if it's this day. I'm pretty certain it's this year, though.
Mark, what a great way to end this interview.
Thank you, Andre.
That author of Nothing But Net, Mark Mahaney. Thanks so much. Thanks so much, Mark. Well, if you've got a question about finance or a comment about the show, we would love to hear from you. Make it pithy, make it concise, and write us at andre@wallstreetwrapup.info. And now for a look ahead for the earnings of next week's show, But first, what instrument of credit was first issued on this day in 1950 that most of us use on a daily basis? We'll have the answer in just a moment. Well, what instrument of credit was first issued on this day in 1950 that most of us just take for granted on a daily basis? The Diners Club credit card. The first credit card that can be used at a number of locations and not just at one company. It all started 72 years ago today. Well, would you like to convert your traditional IRA into a Roth and pay less to the IRS on the capital gains? Well, now that the stock market is down, you may want to take advantage of the drop. By having a traditional IRA, you pay no taxes when you put the money in, but have to pay for the taxes when you take the money out. And with the Roth, you pay for the taxes going in, but you pay no taxes when you withdraw. Now that the stock market has dropped and the plunge only comes once every few years, this may be a good time for the conversion. So let's say you had $10,000 of capital gains in your traditional IRA prior to the sell-off, and now because of the stock market drop, say it's dropped 30%, that would mean that you now would be paying taxes to convert $7,000 rather than the $10,000. Also, if you have a 401k plan from a former employer, you are allowed also to move this into your personal Roth IRA as long as you pay the capital gains on the conversion. Now, as we discussed with Mark Mahaney earlier in the interview, this market downturn will find a bottom and it'll start to rise again. But if you do the conversion prior to the market going back up, you'll save money and it'll save a lot of time and headaches. Also, and here's a tip, when you do convert from your traditional IRA to the Roth IRA while the stock market is down, make sure you have some funds available for paying the IRS on the capital gains that you do convert. The tax bill for that will be due for next April of 2023. Well, if the stock market is giving you lemons, make some lemonade. Well, coming up next week, we're going to be talking with Scott Nations. Scott is the President and Chief Investment Officer of Nations Indexes, the world's leading independent developer of option strategies. Scott is also a regular on CNBC's Options Actions, and Scott also just wrote a great book called The Anxious Investor, which, well, we all are. That's next week, the President and Chief Investment Officer of Nations Indexes, Scott Nation. As a reminder, we repeat the show on Sunday mornings, but the best way, set your DVR so you'll never miss an episode. And that is our show for this Friday the 13th, 2022. Hope you've enjoyed it. My thanks so much to Mark Mahaney for joining us this evening. But as always, it's you. We appreciate you for joining and allowing us into your homes tonight. Remember, follow us on all the social media on Facebook and YouTube, Twitter, and WYES.org. So, have a great weekend ahead and a productive week as well. I'll see you next week. For Wall Street Wrap-Up, I'm Andre Laborde. Remember, money never sleeps. Good night.
Sponsored by New Orleans Distillers, creators of fine spirits and liqueurs. Through dedication to science, art, and passion, blends of tradition and flavor emerge. For you, always locally crafted. New Orleans Distillers, classically Southern.